All right, cool. Welcome to everybody. Welcome to the Independent Investor Channel. My name is Ryan. We're going to go on 1 minute early. We're going to break the rules a little bit. Why? Because we can. I don't have a film crew. I just have me and my Apple computer. Typically, it's my GoPro working overtime. I call it the little mule, pushing out content from a corner of the earth to get the message out to folks. Listen, we're going to have kind of a special episode this evening, and I'm going to offer 50 key terms for you guys as to, I was sitting out on the balcony kind of doing some reminiscing over the channel. The channel's kind of become part of my life a little bit. I really have gotten so much fulfillment and value out of the channel, engaging with folks that I would have never had the opportunity to engage with. I've got certainly my special guests. I've got Average Joe Investing who just popped into the group here. So certainly channel creator, which really helps. So if you have questions for those folks in the dialogue, hit them up. I just saw Ryan T. Calhoun jump in the group here. I've got Brent with the Financial Investor also in the group. You guys will recognize his thumbnail. I did see Joe Carlson also jump into the community here. Want to send a special welcome to him as well. He's doing what I should be doing right now, is barbecuing. The weather's just been phenomenal, so take advantage. Honestly, if you've got the live stream on, kick back, enjoy. So privileged to be able to offer this opportunity through YouTube. I would never really be able to, to reach this many people if it wasn't for the power of YouTube. And, I haven't been doing daily uploads. I'm totally fine with that. You guys know my program if you've been with me for a while. I don't do this to go viral all the time. I just saw Investing Wisely also pop in here. So really always want to try to reach out to the channel creators. Why do I do that? All right, you're going to hear one opinion from me and one opinion only. All right. And I think for the subscribers to the community, and more importantly, the subscribers to the message of financial stewardship, if you hear something from myself, or you hear something from Joe, or you hear something from Dave, or Brent, it's so valuable if you hear something to get you kind of, something clicks, and it gets you thinking about something that you might not want to, you might not have thought of before. And I dismiss a lot of, you can't get value from YouTube, or 10% of YouTube is truthful and the 90% is untruthful. Now, I might agree with that, to be honest with you, because there's really no policing over YouTube. I mean, you can come on here and just say whatever you want to say. Credibility goes a long way with me. It really does. And for these folks that are in my community right now, most of them are. Investing Wisely is not one of my preferred channels. He should be. Does a great job. Puts out a great message. Joe's the newest one, and he, quite frankly, is one of my favorites. I think he's probably growing faster than I've seen some of the newer channels grow, and rightfully so, because I think there's a lot of folks benefiting from his message. What I get out of it is probably a little different than somebody tuning in who's a new investor. I just like hearing Joe and how passionate he is about investing. So he's into the topic about as crazy as I am. And that's encouraging to me, and it should be encouraging to the group who's coming in trying to gain some financial awareness, and we have to be kind of careful on this topic. We really do, and we understand that. But one thing that you guys are learning about financial awareness and financial stewardship and the truth in the financial landscape with regard to the prospects of investing on your own, as opposed to traditional means of seeking out your exposure through a financial planner. One thing you guys are really looking to separate is that There is no perfect way of investing in the stock market. It doesn't exist. All right? It doesn't exist. So if you can watch a channel like me and see how I seek my exposure to the market, or you can watch a channel like Joe or Brent or Dave and see how they seek their exposure, the key takeaway is to identify what it is, the commonalities between us, okay? Do we all seek diversification? Do we all lean a little bit heavier toward the dividend program? Do we lean toward a balanced portfolio mix of fixed equities, ETFs, right? You know, I know Joe's tendencies, and there is no right or wrong answer. I typically try to stay away from you're right and I'm wrong, or I'm wrong and you're right. I just don't believe that's what we need to be prescribing to when there's so many people out there that cannot explain what a stock is or can't explain to me why it is that you invest. All right. Now, at some point, I would love to go through this think tank of things that I'm going to explain to you as to if you tuned into the Independent Investor channel through the chronicle of the videos, what it is these terms mean to me. Okay. Now, they don't have to mean the same thing to you, but I tell you what, I strategically put the most important one right down here over the bull's tail. All right. And a lot of you guys, you know, one of my favorites is the word empower. Certainly empower to mean that if somebody out there doesn't know anything about investing, but comes on and hears something from this community that we've built and gets excited about the prospects of investing, excited about the prospects of going from a preparation stage to a validation stage at some point in their life, what I would hope that they're working toward is this word right here, and it's one of my favorites. It's enrich. All right. Now, this gets misconstrued sometimes, and what I mean by enrich, I came home. I ran my about 3.5 miles before I did my live stream. You guys know I'm married, have 2 kids. Very spiritual. I'm very, very satisfied and happy. I'm healthy. I have a healthy diet. Some of the funny things that I've mentioned through the channel, just at a whim, there's people who hear you out and they're like, man, Ryan, I heard what you said about that diet thing and how you related that to becoming just a better person, to enriching your life. And the reason why I say that is because I talk to people all the time who want to get started investing, okay? But they have a few deficiencies in their life, okay? And it doesn't do you any good to focus in on doing something brand new without working on your total overall picture, because I can tell you what, if you're eating right and you're healthy and you're working towards something, it's gonna contribute to your overall financial health, as well as your spiritual well-being, your personal well-being, of course, your financial well-being. But I really want to stress the point that your financial well-being in your life is it's a small slice to it, and it's very controllable. And to be quite honest with you guys, right now with the market in its current condition, I've probably scaled back to about 50-50 exposure, maybe a little bit more to the cash side of the house. So very, very defensive in nature. I'm monitoring the stock market very closely as far as making new purchases. I'm not really going out there and being super aggressive on buying new positions right here with the stock market in its current position. I am continuing to dollar cost average my passive positions. I'm totally fine with that, right? It's the perspective of winning in an up market and a down market. So we're certainly still funding the passive accounts. We're still monitoring the dividend aspect of the portfolio. The fixed equities is just on fire. I really cannot, I can't complain there. The M1 portfolio that I set up, I shared through the Facebook group. You guys know that I have the 11 sectors represented in the M1 Finance account. That's just kind of a fun account that I've set up, over a little 5% in that account. It's only got $1,600 in there. I'm doing that to prove a point to the new investors that come into the group and want to catch a small piece of motivation that I may say in bridging that gap between the first $0 and $10,000, okay? It's so important when we're living in this preparation stage that we don't fall victim to our own barriers and think that we'll never get out of the preparation stage, because I contend that once you do break out of this preparation stage and move as far away from the status quo as far as what society has deemed for you, the better off you're going to be, okay? And the more abnormal, in a good way, your results are going to be, all right? So Think and Grow Rich, all right? One of my favorite books, but enrich is what we're ultimately working toward, enrich, all right? And I envision everybody in the community having the potential someday. Enrichment to me means reflecting back over your life and not having regrets, okay? You know, trying to minimize the number of mistakes that you make over your life, looking back and say, here's exactly why I did what I did while I did it, you know? And you can reflect back and you can take some peace and some real peace of mind later on in life, knowing that what you did is based on your own accord. And so I just want to thank everybody who's made their way into the, this is the 50th live stream, kind of sick, I guess, but I sure do enjoy this aspect. I wish I could have you guys actually on video teleconference, because I've done a lot of work behind the scenes with folks one-on-one, and I think you guys would really benefit from actually seeing some of those cross dialogue and see how we kind of try to get to solutions for individual investors. But make no mistake, if you tune into the channel and certainly look to get some financial awareness from YouTube, obviously I'm not one of those folks that come onto YouTube and expect that somebody new in the stock market is going to come on and hear me out, or Joe or Dave or Brent or any of the other channels that are offering content, and just go out there and deploy techniques and expect that it's going to stand the test of time. All right. What's going to end up happening is you're going to be ill prepared. All right. And I can't stress, everybody starts here in the preparation stage, and it's very, very important to get out of the preparation stage as quickly as you can. But I got to be honest with you guys, a lot of people can't. A lot of people can't get out of their own way, or they'll take the necessary steps to get out of the preparation stage and get into this planning and maybe even into the action category, only to digress. And that's really the most disheartening thing for me, is that if we could have prepared somebody a little bit better mentally to enter into the stock market, guys, it's easy to be an investor right now. It's easy. I've just been around the block a few times and understanding that when the indicators, and I've never had the indicators really so obvious that they are right now, I just think that this market is defining. It is really defying historical norms. It really is, which makes me, there's a two-sided perspective I have. Either it's going to be a soft landing because the economy is relatively strong right now. I think everybody can agree with that. My other fear is that it could have somewhat of a rubber band effect because it's run so far so fast. I mean, we have a couple days of down day, and that's supposed to be your opportunity to buy. That's not normal, okay? That's euphoria. I mean, it's just, I'm seeing it, and that's what I see, and I could be completely wrong. But I think there's a perspective that I'm seeing that has a lot of truth to it. I really do. So I hope you guys enjoy. I've broken down kind of the progression of somebody who comes to the channel. I had just a great interaction last week with somebody who came in brand new. So I speak from the perspective of not only, you know, my folks in their 50s, 60s who were tuning into the Independent Investor channel for their own reasons. I typically try to manufacture some of those reasons as to why somebody could or should invest. But it's ultimately up to you to come up with those validations as to why it is that you should invest. And it's not for everybody. If you're just going to try it and then pull back at the first sign of danger, then it might not be for you. But I would contend that maybe a little bit more on the preparation side may really help you understand that it's a progression. You're not going to end up over here at the validation stage. You know, this is decades down the line here, guys. You're not going to have this instant success in the stock market. Joe does a good job on his channel chronicling his progress in his portfolio. And I don't know if folks would look at that portfolio and say, Joe, I don't see it moving. I do. I think it's amazing. But to my trained eye, I see it going up incrementally, marching toward a goal. All right. But if you're looking for short-term validation in your accounts, you're probably going to be disappointed. Okay. It's going to be those validations that you look at, you know, in a 5-year period. You look at, you say, wow, I remember when I had $10,000 and now you're approaching $25,000. And you're like, wow, I don't really remember how I got from that 10 to the 25, but I'm here. And the progressions are going to work that way. You're going to get to that 25 mark, and then you're going to march toward 50. And you're going to say, wow, if I can make it to 25, maybe I can push it a little further and push my goal out to 50. Might be a little bit scary, $50,000. I never thought that would have been possible, right? But we push it up to 50 anyway. And lo and behold, you make it because you stick to your program, dividend reinvestment, wealth preservation, tax protection, and dollar cost averaging. Right? You work the system and you stick with your plan, and something funny happens along the line is that you end up tripping and falling and stumbling into those financial goals. It's a beautiful thing, guys, but you have to have perspective. You cannot expect to look at your account and say, wow, I'm up 28 cents today if you're a new investor, and be like, wow, this is awesome. This guy, Ryan, is so awesome. He got me started on investing. I made 28 cents today. I'm sold. Because once the preliminary work of the planning stage and the preparation stage is done, you really have a lot of upfront work to do. But once that work is done and those good quality assets, whether it be stock, ETF, or a spackling of fixed equities to control your risk tolerance percentage, right? Your equities to stock, your equities to bonds. You know, that once that work is done, then you can focus on everything else. You don't have to focus on your holdings. Focus on your budget. Focus on your cash savings. Focus on your fiscal stewardship. Focus on your spending. Identify gaps in your budget. Identify overspending. I can keep going and going and going. The reason I do that is because I'm appalled all the time when people come to me and they're like, Ryan, what's the right stock to buy? Ryan, what's the right stock to buy? Am I okay buying this stock? Of course you're okay buying. Of course you're okay buying Kellogg's, Bob. It's a great company, right? Got a 4% dividend. You bought it on a little bit of a dip. Of course you'll be okay. It's the nature by which you own the Kellogg company that's the key on the Independent Investor channel. You're owning it in the correct bucket, which is paramount, and you own it directly. All right. I've heard lots of validations over the course of my investing career that would allow or make clients think that because they have a dividend payer, that somehow they need to surrender that dividend to a financial planner. And that's somehow the false justification for the high level of fees. All right. And that's the very line of thinking that we're leaving in the past. And we're looking to the future, to use some of these cutting edge platforms that we offer to give you that direct access to the stock market. So guys, I just want to welcome everybody, man. I want to get to the group here. I saw Mike O drop a comment on me. I'll deal with this one first. I took a year from zero, but I jumped over my $10,000 goal today. So it was funny. I was sitting out on my balcony just before the live stream. I'm a pretty reflective guy. I'm pretty openly an introvert actually as well, which is kind of funny. It's even more funny when I get to talk to another introvert. It's an interesting conversation for sure. But I was like, you know, I would love to hear some validation back from some folks that actually take the information, whether it comes from myself or another channel, something maybe funny that I've said, maybe something that I've said on the channel that really impacted them. That's the best payment I could get. When somebody comes back to me and says, hey, Ryan, you mentioned something about diet, and I look to cut out this, this, and this in my diet, right? That has nothing to do with investing. But if we're getting this enrichment piece for people, then we're striking at something beautiful. We really, really are. Because that type of stuff, as non-related as it might be to investing, is going to make you a better investor. All right. If you don't trust me on that, then why the hell are we working so hard for financial security in the future if you're not healthy enough to enjoy it, right? If you're not mentally prepared enough to not only put a plan in place, but walk the plan and then reflect on the plan that you put in place and be proud of yourself. Be proud of yourself. That's the enrichment piece. All right. That's what we're talking about. So now at 10,200, I'm going to be smart this year. You come into the channel and drop a comment like that, I'm going to be the first to congratulate you, because what you've done, that's pretty awesome. And there's an infinite number of ways you can go from that zero to your first 10,000. Okay, infinite. And there's no path that's similar. It doesn't matter what you hear from me. It doesn't matter what you hear from the other channels. But if you were empowered to go out there and seek out an investing plan and put that plan into place the way that it makes sense for you, look what you've done. Look what you've done. You should be very, very proud of yourself. You're really on your way. And I don't know the statistics. There's probably somebody. I've got Greg Cammie in the line, is very sharp, very, very smart, astute investor. I do have Joe in the group who's also very astute, but I think the percentages are very staggering of people who have that $10,000 or more. I think it's in the top 90th percentile of the population who actually have those type of dollars put away. So you've actually put yourself into a fairly elite crowd. Now, I would say this to you. Was it really that hard? Was it the education that allowed that to happen, or was it magic? Of course not. Would you say that because Mike O did it, that maybe somebody else could do it as well? Is it scalable? That's the key, all right? Because when you tune into YouTube sometimes, and I don't even watch other stuff anymore, I can't. It makes me sick, honestly. It actually makes me upset. It makes me upset for the people who consume the content and won't extract real, tangible, usable value from the content. All right. Now, like I said, I'm given this delivery from my living room, right? Not professional, not scripted, right? But the measure of the content is, can you take it and use it? And you're just an example of somebody who has taken whatever path you've taken and you've hit what I feel is the most difficult. Some people will manufacture that 10,000 goal because they can, but my hat's off to those folks that started with zero. And I'm taking your comment at face value that if you actually did start with zero and you're up over 10,000, my hat's off to you, man. That's pretty awesome. And that's a killer statement to make. And the first one I get to address on my 50th live stream video. I just couldn't be more proud. I'm more proud of that than I am of mine. I've since forgotten those milestones 10,000, you guys, I've been very open with you. That was kind of the big milestone for me because, again, I don't come from money. All right. So for me, $10,000 was unobtainable. It was impossible. It was an amount of money that I would never get to. Barriers that sound familiar to some of you guys if you're working through some of the same mental barriers, and they're all mental, all of them. And Mike O has just dropped a comment to the group here, should prove hopefully maybe to one or multiple folks in the community or folks that catch the live stream after it's done, that it's not magic. It is an overcomable barrier, you bet. And if you've got to do it at $25 a clip, man, do it. Do it. Don't allow yourself to get into your own freaking way. All right. Allow yourself to be free, because if you got to get over those mental barriers, because unfortunately in investing, you can sometimes be your worst enemy. You really can. So my hat's off to you, man. That's really, really good stuff. Right below, I've got Jeff Koski in the group as well. Hello, my friend. Hope all is going well. We're having the Apple Blossom Festival this weekend. Going to be a good weekend here in Washington State. Man, I miss the Northwest. Holy moly. God, I got some conversation going back and forth in the community about the Northwest, and I certainly miss it. It's pretty nice here. Pretty nice weather. You can see the independent investor got a little tan. Spent a little time on the beach. I was doing a Navy SEAL workout pretty much on the beach this week. With my tongue hanging out of my mouth, trying not to get sand in it, but it was pretty fun. But listen, the first column that we got in preparation and stuff that we talk about, we don't talk about it enough, but we talk about getting the mental fitness correct. So the word budget, it's synonymous with diet with me. I don't like the word. Okay, because budget can mean something different for a lot of people. For my younger community, it's downloading an application that can help itemize expenditures and help you put it on, your iPhone, and you can actually see where your expenditures are going. For some of my older school folks, it's better to actually write down the budget. And when you actually work through a financial planning worksheet, and you're actually able to put those expenditures down on paper, you can look at those expenditures and say, wow, I might be able to cut back a touch on this, But budget is super important. The planning piece is awesome. And it takes a little bit of education to hit the planning correctly. But the real key here is to be open to the education. I find all the time when I mention finances or stock, I'll look into people's eyes and I'll see their eyes drop and they just want to shut the conversation off altogether. Don't believe me? Test it. Test it. Because it's just one of those topics that can be faux pas. And that's why I always endorse and acknowledge the other channel creators, because they're trying to do the same thing I'm doing, or at least I hope they're trying to do that, is to make people aware of all the different approaches to the stock market, and you can win at all of them. You really, really can. But it takes somebody opening their mind a little bit to the education piece. You don't have to learn it all at the same time. You don't. But if you open your mind to some new perspectives, you can make that much more of an educated decision about what direction or what course you want to put your investing career on. Because the unfortunate misery about your investment decisions is that when you put that plan into action and you put it on a course, unfortunately, the ramifications can be very, very damaging if you put that course on the wrong course. And unfortunately, you're about as ill prepared to put that investing course together at its inception. So it's a tough spot. And that's why I always encourage, certainly validate getting out of this preparation stage and into the planning stage as quickly as you can. But I try to make those bridges for you and make sure that those critical pitfalls are avoided. And if you listen to the channel and you listen to the catalog of videos, I'll help you sidestep a lot of those landmines and common problems that folks all too often get mixed up into. And then unfortunately, they get turned off of investing and they never end up reaping the rewards of a proper program, and never really get down here where they've got stuff working for them, where they're in the monitoring category, or they're maybe lucky enough to get to the validation stage, right? Encouragement is cool. Like, you know, when I had my financial planner, I'd go in maybe once every 6 months. And honestly, I think if it were up to him, we would have met once a year, because our meetings, I insisted that they were very engaging. And, you know, I'm a nice guy, but I mean, you're my financial planner. I mean, you tell me what you see. Give me some gaps. Give me some areas of improvement, man. Come on. I didn't really realize how much I was paying him. So if now I do, I realize that. But if you can come on the Independent Investor channel and get a little bit of encouragement and kick around some questions with a very, very capable crew, I think there's inherent value in that, especially if you're good at disseminating opinion from fact, okay? And there are facts that are there to be disseminated. What investing platform do you want to use? I know Joe prefers M1 Finance. Brent and Dave, myself, we all have accounts. That's a commonality amongst us. Now, our method by which we utilize that bucket is going to be different, okay? So that's fine. But if you can take those commonalities and say, okay, let me extract the juice here and say, what is it that these guys are seeing in this M1 account that potentially I can benefit from? Is it free investing? Yes. Does it have portfolio dividend reinvestment? Yes, it does, right? Does it have partial share accumulation? Yes, it does. Is it easy to use? Yes, it is, right? So you start checking all those boxes, and it can really help with the encouragement piece if you come on and you get these ideas. I don't think I would have ever known that M1 existed had I not had this great group. And I mean, I'm like a sponge now on YouTube. I'm soaking it. I'm way better investor than I was 2.5 years ago now, because of this community. And that's the encouragement piece. The inception is one of those things. Breaking the ice is another word for it. And unfortunately, everybody who starts investing has to go through this form of deliberation when they first start anyway. We try to fast track you as best as we can. And we're just ordinary fellas. I don't know much about Joe. I've known Financial Investor. I've known Brent a long time, and I've known Dave a long time. And I think they're just regular people. I think. I'm pretty certain they're not robots, okay? I'm pretty certain I'm not. I'm pretty sure if you cut me open, I would bleed, okay? We're just regular people, all right? We really are. We're regular people. You guys know that I have a career. I don't do YouTube for a living, right? Why do I continually say that? I don't say that to belinger a point. Why I say that is because people can relate to my story and say, geez Louise, this guy, you know, makes a salary, right? About an average salary. If he can do what it is that he can do in the stock market, I can do it too. And that's okay. It's okay to feel that way. And if there's other channels that say, geez Louise, this guy's 20 years old and he's killing it, you know, maybe I want a piece of that too. It doesn't quite have to be to the Ryan Scribner extent, but you know, I watch a guy like Ryan Scribner and his age is irrelevant to me. It's irrelevant. He strikes me as just a very, very successful individual. His age means nothing to me. Now, the fact that he's done it so early on his life is quite impressive, right? But it's motivating for a guy like me that observes that type of success. And it's like, wow, this is pretty cool. And it should be motivating to you guys too. Nate, I put Nate in the same category. All those guys that are just making really good money on YouTube. You know, the empowerment piece is what I talk about all the time. And this is something that I really have to curb this sometimes, because I know there's people that tune in to Joe and Dave and Brent and Ryan and especially the financial education, certainly that just tune into the channel and deploy what it is that comes out of his mouth, okay? That is not the mission of my channel. And I can only speak on behalf of my channel, okay? I'm not doing my job if I come on here and I say, hey, listen, I bought Google this week, and you go out and buy Google on Monday and not know why. And even if it doesn't fit in your portfolio. Hey, Ryan added 50 shares of Pfizer to the portfolio. I'm going to go add 50 shares of Pfizer, and I'm not going to do at least some surface level validation as to why I do that, what my exposure to healthcare is, why I'm making that purchase, whether or not I'm underweight and adding more exposure, whether or not I'm adding more dividend exposure to the portfolio, right? Simple questions, guys, but I want to make sure that you're asking the questions and can validate why it is that you make those moves for yourself. Okay, it never ever can be about me telling you to do that. Now, if you want motivation, great, take the motivation, that's all good. But make sure that you're at least able to articulate, at least from a beginning investor's perspective, why in fact you're investing in Pfizer. For example, it would be for the 4% dividend, right? I wanted a dividend payer. I needed some healthcare exposure to the portfolio. I wanted the best in breed, right? The price was right, the valuation was right, some of those things. Be able to kind of run yourself through that and practice why it is that you do what you do. That's empowerment. When we've taught an investor to make those decisions on their own and run and deploy these techniques for their own benefit and not just be reactive on what they hear on YouTube, then we're winning the battle, okay? And we'll continue to strive toward that empowerment piece. Perspective is huge. And I put this in the category of identifying where the status quo is, what seemingly society deems acceptable in the investing landscape, and looking to entertain a new perspective on how it is that you enter the stock market on your own, okay? The effects can be insurmountable, all right? And I don't know, I haven't watched all of Joe's content. I know Dave and the Financial Investor, they've been with me for a long, long time, so they know the importance of owning those buckets, the importance of self-directed investing. But this is very, very important to not only have the perspective and understanding of how much you'll save long term, but to really, really own it. Be proud of it, okay? Defend it, all right? Because you're going to be inundated by the news media, right? Because they've got those billions of dollars to throw on advertising. Every single commercial you see on TV comes on, basically would have you believe that you do not have the expertise to buy Home Depot, okay? The expertise to buy Duke Energy. You don't, right? So I think they try to make it sound so impossible that the common investor looks at it and says, you're right, I can't do it. I have to seek out your service because you're making it sound so unique that I have to seek out my access through you. And that's one of those notions that need to be dispelled. You need to at least entertain the other alternative perspective of investing on your own, all right? The benefits are insurmountable, all right? The awareness piece is huge too. Really just kind of understanding that this option exists. I have people all the time that are just like, geez, Ryan, you blew my mind. I didn't even know this was possible. You mean to tell me that I can buy and sell stock in a Roth IRA, and I can do so. And if I sell stock, I buy stock on Monday and I sell it on Wednesday and I make, let's say, $100. You're telling me that $100 is tax-free? Yes, it is. It's protected. And there was a time in my life that I didn't understand that, you know? So the more we can become aware of our rights, our benefits, every single year that comes and goes where that max contribution limit is not met, you're losing out on that benefit the older that you get, all right? That's the way I look at it. And I used to look at it in this way on a $6,000 contribution schedule, right? You got 25% of your benefit is $1,500. That's just a little over $100 a month, guys. There's a lot of people in the audience who will look at that and go, wow, I look at 6,000, that's a lot. But what Ryan just said makes a lot of sense. $1,500, I can do that. I can do $125 a month. That's awesome. Now you're taking back 25% of your benefit. Sooner or later, after you get into the habit of doing that, you're going to want to bump it up to that 50% level and 75, and then soon enough, you'll be max funding that account. And even if you don't, at least you're realizing back some of your government given right to that Roth IRA, the ability to tax protect money into the future. Okay. All right. Connections. This is a big one. You guys are doing that right now. And I'm not a professional. I don't need to be a professional to make money in the stock market. I've always contended that those two things unfortunately get thrust into the same arena and they stick together, and that's what people believe as gospel, and it is not. I contend that the brand new investor right out of the gate who puts Pfizer into a self-directed Roth IRA account owns Pfizer in the exact same manner as the client who has representation on the financial planning side of the house. All right. The only difference is the self-directed investor, all things considered constant, will win every single time because of the fees that are subject or held over this account over here for the client. Okay. So just keep that in mind. The last thing here under the preparation stage is hope. And when you're a new investor, you need to bridge what you think is possible in life, okay, from your mental barriers. Okay, it's the only thing that's going to allow you to get over your initial barriers, okay? Because some people are so caught up in their barriers that it prohibits them from even entering into thought that allows them to have hope for the future. And I'm telling you, if you tune into the Independent Investor channel, and a lot of people do, because I'm very, very positive, this line of thinking that I have, this didn't come overnight. It didn't. It's been a lifetime in the making, a lifetime. And I'm successful now. I was successful 10 years ago. And some of you guys might hit me up and say, what do you mean, Ryan? You're not a millionaire. It doesn't matter. You're missing the point. You have to think and grow rich, all right? Being on a path toward riches right now, being realistic from where I've been and where I'm going is the key. I don't get down on myself because I wasn't bestowed upon wealth. That's not fair to do to myself. And it's not fair for you to do it either. And if you just get out of your own way, give yourself a little bit of hope, you'll be so much more better off, and actually give yourself that chance, man, to progress through these stages. It's awesome. It's awesome. And I'm so excited for you guys that have the prospect and are actually kicking back some success. I knew this would happen in the community eventually, where you guys start to share some of these testimonials and kick it back to me and say, you know what, Ryan, I heard what you said. This is freaking awesome. I did this, and now I'm producing real results. I guess my question back, and I don't mean to sound arrogant, is would you have been able to produce those results on your own? I needed help. I needed help at some point in my life to hear these things and think this is possible. I needed to have the courage to break away from what I thought was right. But I'm here to tell you, just because you think it's right doesn't mean it's right, okay? I do believe there's a fundamental truth in investing, and we will continue to work and try to claw away at that fundamental truth. And that fundamental truth has a lot to do with giving individual investors 100% of the potential power, and not partially giving investors the power to make returns into the future. Very, very big. Good stuff. All right. I'm going to cruise to the top here. We've got column 1 out of the way, man. So this took me through the first 10 videos. Obviously, we're gonna go through the rest of the 50, and you guys will benefit from hearing my perspective. Hopefully, I'm gonna cruise up here and see if there's just an absolute wow. There's an absolute script. I've got Dave Matthews in the group here. Just a ton of folks, man, investing wisely again. I have not been finding a lot of buys right now. I haven't either. I'm right with you. I hope you guys catch my perspective. If you're a $0 to $25,000 investor, hell, depending on how young you are, I would say $0 to $50,000. Don't worry about the condition of the stock market. Don't. Okay. But you know, for somebody like myself who works as hard as he can, and this might be wrong, right, wrong, or indifferent, I'm just giving you my pulse of the stock market, in that the way I'm managing my few $100,000 is that I'm managing it very, very carefully. And for the stuff that's in cash, it makes me sleep easy at night. I am not 100% invested in the stock market. Some people have the tolerance for that. I don't. And some people might look at me and say, Ryan, you're crazy. You're missing out, blah, blah, blah. No, for the money that I have invested, it's working for me. Don't lump my cash pillar into my investing pillar. I don't cross-contaminate that way. I don't. I look at my investment capital and say, out of my investment capital, I have X number of dollars invested to the market, making dividend income, making passive income, making fixed equity income, etc. My cash pillar, I don't look at my cash as being a negative thing. Now, where the cash is going to come in handy is where I start to get a 10, 20, maybe a 30% downturn. If we start flirting with a 40, 50, that's when I'll change. I will change my perspective, and I will change it at the time where I will have tomatoes coming through my computer from some of my audience members. All right. I got them last fall, and those people have since crawled back under their rock. All right. And they've stopped throwing tomatoes at me because I'm the biggest idiot in the world, because I choose to be an investor in the stock market and everything's going to hell in a handbasket. Right. And, you know, it's fun to sit here and talk about how good and rosy the stock market is when it goes up, but it goes down sometimes too, you know? So the time to prepare for that is now. And the way I prepare is by hedging capital. That's the way I do it. All right. All right. Live stream number 50. That's right. I've got Chris Blaine in the group. Good stuff. I'm going to check and make sure I'm hitting all these questions. I started with Mike, so I'm going to scroll down here. That's what I'm looking at. Going to ask again for you, Ryan, to make your M1 dividend pie. I did. I threw it in there. I thought you were the one who got back to me on my Facebook group. I threw it in there. It's kind of a boring portfolio, to be honest with you. And sometimes boring makes money. I like those spider ETFs. I really do. I know I've got, if Joe's still listening, if he can pull his ear away from the barbecue for 2 seconds, don't burn the hamburgers, whatever you're cooking. But it's cool because I like his perspective on, you know, he compares the dividend investor to the passive ETF investor, etc. I think they're both good. To be honest with you, I do both. And that's typically the approach I like to take to the stock market. Is I don't typically discriminate on one particular style. Now, right now, would I be full bore growth investing? No, I wouldn't. And I know he tends to gravitate more toward the dividend investing style. And he's got a very, very polished rationale for doing so, that of which I aspire to. I think it's perfect. I mean, the sky's the limit for him. No doubt about it. His perspective is very sharp. He you know, not only has a plan, but can articulate why he does his plan. It's awesome. But energy sector, yeah. So I did share that. So for anybody here that wants to kick over and join the Facebook group, they certainly can. It's growing. It's got like over 1,000 people in there, which is really cool. I'm really, really stoked. I'm very, very proud of that product, and just hope to heck everybody's getting value out of joining that group. It's awesome. Energy sector's down 17 in relation to the S&P, looking for bargains there. It might be. I tell you what, energy investing is not for the faint of heart. It's not. It's a very, very tricky sector. I do think Marathon Petroleum is about the best of the breed. You guys saw the deal today. Warren Buffett gave out a little loan to Occidental in the form of $10 billion. That was interesting enough. Occidental's a great company. Anadarko, Apache, all great companies. You guys know I'm long ExxonMobil, Chevron being the better of the two in my opinion. But I do own them both. You know, I'm a big fan of Valero. Where I won't invest in certain sectors or subsectors like casino stocks, I typically try to stay away from automobiles. I do like the rails, but I do like energy. I really do. I think you shouldn't ignore energy at all. I've made a lot of money with energy. It's just volatile. It's not utilities. Okay. It's not the utility stocks that you can be rest assured that you're going to buy and you're going to be paid a dividend. And it's just going to be a boring way to make money. I didn't just say that, because making money is awesome. It really is. Utilities is one of my favorite sectors. It really is. But I choose my utilities exposure in a little bit different manner. You guys know I invest in the VPU, which holds about 148-ish, I guess, companies in the VPU. It holds them all based on market cap, starting with the largest one, which I want to say is Nextera. I could be wrong, but I know Southern Company is in the group there, as well as Dominion Energy and Duke and Dominion. So some of those larger utility companies. That's just the way I choose my exposure. I am looking at Duke and Dominion. I've owned it off and on, made money every single time with it. But they're going to be your higher dividend yielders, and you're not going to get just gangbuster growth out of it. But ExxonMobil, I've owned it for a long, long time. I don't know how many free shares I've got of ExxonMobil, but I'm glad to own the company. It's $367 billion company, pays a fat dividend. I'm happy with ExxonMobil. So, if you want to take a crack and enter into energy right now, go ahead and do so. That's fine. But just be very, very strategic. Scale into your positions. Don't get crazy. All right. And if you just want to make your life easier, go ahead and buy the sector energy ETF. You can do that as well, which is what I have exposure to in that M1 pie. You can grab the ticker symbol off of the Facebook group. So, yep, my VDE is taking a beating, energy ETF. I don't think it's that bad. So I've got all good. I don't know how much you have there. I typically like to use the sector spider ETFs if you have the ability to own them all. Okay. Because if you're just going to try to piecemeal it and try to pick the winning sectors, you're going to have a hard time doing that, because you're going to zig and buy energy while the technology's taking off. Or you're going to buy technology and it's going to tank while healthcare goes up, or vice versa. So I typically like to own them all, because in my portfolio with all the sectors, yes, I am down a little bit in the sector spider ETF, but I'm up in the overall portfolio because those other sectors are outperforming. And don't forget real estate. All right. So I own my real estate exposure through the VNQ. That's the way I do it. AMT, Simon Property Group, being two of my favorites out of that sector. But I just own the underlying ETF right now. And again, these will be stocks that I look at when I get a little bit better valuation. The valuation on American Tower is not that attractive, even with the attractiveness of the business and owning the stock. It's an awesome company. So, but great comment. Just be careful a little bit. I don't want to get on here with the whole full throttle buy authorization and say, yeah, just buy everything, because I think this market is going to be selling in May and going away. That's what I think. And again, I may be wrong. That's fine. I'm prepared to be right. So just kind of keep that in mind. At this stage of the 10-year bull market, take profits, and having cash is key. Again, try to do both, get the best of both worlds. If you can have some cash on the side, for those folks that are just justifying being, overly levered to the stock market, I think if you're hearing me out and you feel like maybe, geez Louise, I've got, I know Joe's portfolio is looking really, really good. He's so diversified within the portfolio to an extent. You can't be fully diversified with single stock. He would agree with me on this. The only way you can be fully diversified is through an ETF, passive, index fund, mutual fund, etc. I can't believe I just said mutual fund on my channel, but it's true. Mutual funds are diversified. As crappy as the products are, my preferred method of seeking diversification is through the ETF. But if he heard me and said, well, I'm sitting on 35,000, but in my savings account I have $500, you don't have to panic. You just say, well, maybe I can go to work on that cash pillar a little bit better. That's all. It's an area of improvement. That's all it is. It's not the end of the world. I mean, who knows? This market could continue to smoke and end up melting up. It happens. I've seen it. I don't think it's going to. I think we're having a melt up right now. So I've just never seen the stock market do that. So two-way live stream. No, I'd have to wear pants. Nah, yeah, me too. I'd have to wear pants too. Nah, for sure. For sure. You guys catch the bit. That's one of my favorite moments on YouTube is when I showed my feet. Don't need to wear a suit and tie to be credible. You don't. Evidently, it means everything to a lot of people, but I contend that it does not. All right. Be credible with your information. Make sure that your information works. That's good enough for me. I don't care how you dress. I don't care where you come from. I don't care what your socioeconomic background is. I don't care. The stock market doesn't discriminate. All right. All right. Let's cruise down here. For my kids, I buy them VTI. It's really good. So I've got Dan Tanks in the line here. For my kids, I buy them VTI and BND at this point. Would going heavier BND be a possible good play? Certainly. I think your idea there, you didn't give me the bucket that's in, if it's in a UGMA account for the kids or if it's in a 529. Either one are good options. You're investing the exact same way my brother does, but depending on how young the kids are, I'm not really sure if I'm a proponent of having BND in there. I mean, they're super young. VTI, I mean, how much more diversification do you need? That's the flagship Vanguard's ETF. I mean, that's exposed to over 3,700 different companies. If you're really looking at building wealth into their future, maybe transitioning it someday into a Roth, don't underestimate the importance of getting young kids invested in stock. And the VTI is that's fine right now. But I think you could probably even just own 100% of the VTI. I'm not really a proponent of splitting it up for kids. Get them invested in the stock market, man. They can go through some swoons. Buy them some single stock, for crying out loud. Buy them a few shares of Disney. It's not going to hurt. All right. Buy them some J&J, some JP Morgan, some Bank of America, whatever you prefer. Buy them some Home Depot. If you're a Lowe's shopper, buy them some Lowe's, but it could be a good play, I think, but don't get too crazy. My exposure to the fixed equities right now is 10%. That's it. So about 25,000 to 26,000 of the investable portfolio is devoted to the Vanguard ETFs, and they're doing very, very good. I'm so happy. If there's nothing else I've learned, is to not try to outthink some of the traditional methods of proper portfolio allocation. Okay. And that's one thing I would say about those folks that pick one style of investing, whether it be growth or whether it be dividend investing or whether it be, whatever it is. You may be doing this over here and you're doing it very, very well, but you may be potentially missing out from some of the defensive benefits of having an 80-20 mix or a 90-10. If you're young enough, do a 95-5, just something to give you that counterbalance to where you're making money on the fixed equity side while your equities might be in a little bit of trouble, or maybe they're appreciating or depreciating. Okay. But it's a good counterbalance to the portfolio, and it can really help hedge your risk and define your risk tolerance, right? So for example, if you're a moderately aggressive, you should be around a 65-35 portfolio, 70-30, 80-20 starting to get a little more aggressive, 85-15, and then finally a 90-10, 80-20. That's still really kind of getting into the aggressive, ultra aggressive investing profile. But there's really no portfolio models out there that support 100% exposure to equities. Okay. Every portfolio calls for some level of exposure to some fixed equities. I just think the younger that you are, the less necessary it is in the portfolio. And the older that you get, I think you should really start to look to transition from equities to fixed equities over time. and start to get some of that fixed exposure in the portfolio over time, especially when you hit the 50 mark. If you got that already put away and you're in your 50s, 60s, 70s, 80s, no problem. You can invest. Just make sure that you have those layers to protect you and make sure that you're not vulnerable to a big downturn. Always ask yourself the rhetorical question, what if? What if I had a severe downturn? What would my portfolio look like if I took it into a severe downturn? Do I have enough layers? Do I have enough expendable cash? Do I have enough income on the other side, Social Security, etc.? Things like that, all right? Don't be afraid to ask those scary questions, okay? Because you don't want to be answering those rhetorical questions at the wrong time, all right? Good stuff. Things are getting frothy. Spent the last 2 days taking profits, but I just don't want to sell too much. That's the golden question. It really is. There's no right or wrong answer to this, but if it feels good to you here taking some profits, you're never going to hear me say, you're doing it wrong, or you're taking profits at the wrong time. This is something that I always come back to my philosophy of having those investments in the portfolio that you do own for forever. Okay. Now it's easier to channel growth stocks than it is, let's say, a dividend payer like a Pfizer, for example. But here's the thing. If I just bought Intel, which I think is one of those companies that you could just buy and own forever, okay? I bought it, owned it for 3 weeks. It ran up to 57 and it ran up fast. Boom, 13, 14%. Boom, I'm up $800. I took the profit. I got lucky. Stock drops, okay? I just reintroduced a new position to Intel yesterday, all right? Now, right, wrong, you can't time the market, Ryan, right? No, I didn't time the market. What I did was I was opportunistic with my opportunity, okay? I decided to take profit off of Intel. I got lucky. It went down. Could it have continued to 65? Of course. I say all the time, the stock market is a very humbling arena. It will humble anybody to their knees, and it will humble you the second that you think you got it licked, all right? You'll be like, Jesus, dang, I didn't see that coming, all right? But I guess the lesson in that is never become married to a stock in that you're so against taking profit if that's what you want to do. The profit taking in Intel had nothing really to do with Intel in and of itself, as opposed to taking some off the table with my technology exposure. I had a couple, 2, 3 really hot days in the stock market, just decided on that third day that it was a good time to take profit. Okay, now what do? Do I forget about Intel? No, I brought the position down to 11 shares, so I'm still getting the dividend reinvestment, right? Then I monitor the shares. And it just so happened to help me out. Boom, drops down to 50. I pick it up again. Right? Could it have continued down to 42? Yes. Am I willing to take the stock into that level of a downturn? Yes. I've already locked in $800 profit. But just to give you an idea of some of that opportunistic opportunities that I take, as this game is about money. It's about money. It's not about becoming married to a stock and never, ever entertaining the idea of maybe taking some profit. But I do want to stress that part of your portfolio, if not a good portion of your portfolio, and especially if you're a full dividend investor, and depending on the amount of exposure and the number of equities that you have within that portfolio, Joe invests in an interesting way. He takes a few shares of a lot of different positions. And I like that. I like that. Does it benefit him to go up 3 or 4% in a stock and take profit? In my opinion, no. I don't know how old Joe is, but if he's young like I think he is, it's doing it smart and just stay the course, right? It's better to just keep that dividend reinvestment program. I'm quite certain that he funds the account on a DCA schedule, of course, right? A good, savvy investor does that. So, you're working the portfolio in a lot of different methods. And he's prepared to take the portfolio into a downturn if we enter into a recession. And for all I know, he's prepared to benefit from that if it does enter in and buy more shares. So, to each his own, but you can kind of see the philosophy. Always give yourself an option and stick to your plan. It's really, really good stuff. All right, for now is good. Average down on BPT. Ryan gives good advice in bull and bear markets. I do, because I'm a realist and I've been around for some of these times. And there's some real concerns that I have with the current stock market. I'm concerned with the level of debt that we're carrying. I am concerned a little bit with how fast the stock market has run up over the last 2 years specifically. We were below 20,000. You guys remember? We were below 20, and we're approaching 30. Round up. We're over 26,000 right now. We've run up fast. We really have. And I'm not going to be in the market 100% right now. No way. However, if this market does do what I think it's going to do, I will be sitting like a rattlesnake, coiled up next to the trail, waiting. And I will look to make a big move on the stock market. Why? Because I'm a very, very experienced investor, and I know that the time to push will come eventually. I just don't think that time to push is right now. I don't. So that's just my opinion. And thank you for that comment. I really appreciate that, Dave. Saving on the plane trip to Vegas, baby. Good grief, man. I was married in Vegas, man. I was married in the top of the stratosphere. You betcha. It was awesome. Chapel in the clouds. It was awesome. Still just as happy today. I'm happier now than I was 14 years ago. Awesome stuff. So when Ryan says going with the cash, is that adding cash to your brokerage account but not buying new positions? It could be. It could be just as simple when I say that to be adding money to the savings account. So I have multiple cash buckets right now. I have cash within the Roth IRA. Okay. Now that is the least beneficial to me. Cash in the Roth IRA is the least beneficial to me. All right. But I've got about, oh heavens, within both of the Roths, there's probably 25,000 in one of them and about 40,000 in the other one in cash. Okay. But accounting for the invested capital, we're talking about close to 50,000 in one and close to 65,000 invested still. Okay. Now, why do I say that's a dangerous position? It's because we've worked very, very hard to get that money tax protected, and we want it to grow unobstructed and compound in the future. So I'm taking a little bit of risk off the table, but I'm taking some risk in keeping that cash in that account and becoming stale and not working for me. Okay. I get it. I'm taking the risk. That's fine. I'm good with it. But then there's cash in the brokerage account and finally cash in the savings account. There is no cash in my employee sponsored. I keep that fully invested all the time. That is a 100% passive account. And then, of course, the other two buckets, the first trade bucket and the M1 finance bucket as well, is completely 100% invested and 100% passive. I don't mess with it. I don't. I monitor it. It's fun. That's what I do. All right. So I've got the cash in multiple pillars across the accounts. Okay. All right. Christopher, I think cash equals cash or T-bills. It's worse, actually. Cash does not keep up with, if you want to go with a short-term bond ETF or something, you could do that and you'll barely outpace inflation, which is about 2.2%, which honestly, that's a smart answer. If I asked you, why do you invest, community? I would want you to come back to me and say, I invest not because I want to, but because potentially I have to. All right. Investors are forced to invest so they can at least keep up with the pace of inflation. And if nothing else, if you're going into fixed equities to outpace a little bit inflation, now you're talking. That's smart. That's smart talk. And hopefully you're investing to outpace a little bit more than that, because if you're losing, 2.2 year over year, we're losing the value of our currency. We have to invest. We have to. Us little fellas, we've got to invest. All right, it's a requirement. All right, I've got Noella in the line here. Hello to you. Awesome, so awesome to have you in the community, tuning in from Canada, the beautiful country. Awesome, great to have you. It's great to see you this evening. Hopefully you're still in the community and I didn't get to you late. I'm sorry, I was kind of on a rant for my first hour, but that's all right. Is there any such thing as a financial advisor telling me it is too complicated to tell me what my investment costs are? That is awesome. I should take a picture of that comment, because that in essence is why I came out with the channel. I put a video online where I demonetized it because I broke the trademark rules. It was fine. The trademark, if there was money to be made, but I just love the video so much that I put it online anyway as an undercover story, and it was actually based in Canada. I've got Wella right above you. So it was unfreaking believable, and I know we've got this stuff going on all that. They hate guys like me, man. I swear I should do an undercover op and just go in and film it. I don't know. I'd probably be arrested, which is not cool. And I don't really want to be arrested because I'm not a lawbreaker. I'm a law-abiding citizen. All right, but yeah, look, these folks, man, are salespeople. Okay, and I'm not saying that you can't be a very, very good financial planner, that of which can sit down with a client, have the client's best interest in mind, be a fiduciary, and actually sit down and be very, very good at your job. Very, very good. And I'm not saying that there's not clients out there that need that level of service. I'm not saying that at all. It can be beneficial, but you're going to pay. You're going to pay. My thing on the Independent Investor channel is to define what is necessary and what is extracurricular. Okay? And passive investing doesn't take an education. I would contend that dividend, if you want to get some education, watch Joe's channel. He should charge for it. All right. He knows I don't charge for my information, and nor does he. But geez Louise, man, if you're really serious about this stuff, consume some of this content, guys. It's not that hard. You'll consume the content and you'll be like, dang, I understand what their philosophy is. Buy very, very good quality companies that pay a dividend. I'm going to get paid every quarter to own the stock. I'm going to be an investor, for crying out loud. Stop trying to think that you want to be a trader. And the thing about it is I always try to differentiate between the two agendas, okay? The agenda of the financial planner and the agenda of what should be for the independent investor, right? The self-directed investor. Two completely different agendas. This agenda over here can be a little bit more defensive because you can have some cash on the side. The financial investors, they're going to want all your cash. Okay. Go in with $10,000 and you say, I've saved up $1,000. I want to invest. They're going to put you into 2 or 3 mutual funds, and that's going to be the end of the day. They're going to shake your hand and say, thank you so much. You're with a winning team. Okay. That is not the truth about what is going to be the most beneficial for you. It's not. It's just not. The numbers just don't match up. Okay. So I got Greg right below. Heck, 0.28 is money. Exactly. Is there any such thing as a financial advisor telling me it's too complicated to tell me what my investment costs are? God, that's amazing. There is. There is absolutely such a thing. And it's either incompetence or it works. All right. Some people will listen to that stuff and they'll do this. That sounds good. Yep. Okay. Yep. It's too complicated. So it's too complicated for you to explain to me. But I can still invest, right? Oh yeah, you can invest, no problem. But you can't explain the fees to me? No. But I can give you the disclosure form. It's 43 pages. You can read it if you want to. All the information is in there if you want. You take the 43 pages, you take it home, and it sits on your counter for like 2 weeks, and then you throw it away. That's reality. Okay. Let's see, tanks. That's what I did, but there seems to be an unusual correlation of stocks to bonds. I'm not experienced bond holder though. And yes, green cash, whether in your checking or brokerage, but not stocks. Awesome. I've got Pokey. Is first trade really good? I heard everything is good until you tried to withdraw funds. Yeah, I'm not sure about that. I had somebody that came on and they were talking about how difficult it was to withdraw funds, but they didn't have any money invested with them. I'm not sure. I did pull money from M1 Finance. It was a piece of cake. You guys have to understand, if you've never ever been through the exercise of withdrawing funds from a brokerage account, it's going to take you about 10 days. Okay. They're legally obligated to pay you the money, and it has a lot to do with the receiving brokers. So for example, if you wanted to go with like Merrill Edge or Merrill Lynch, they just changed. You call Merrill Lynch and you say, draft up the paperwork, send it over to First Trade, solicit that account. They have to sweep that account over and over again, because depending on how established the account was, it's going to continually pay owed dividends. They still owe you those dividends. Even though the account has been swept and liquidated, they'll continually sweep that account, sweep it, sweep it, sweep it. And they're required by law to sweep it for quite some many months, okay? So they won't actually close that account until it's completely liquidated down, okay? And it just takes a few weeks to get it liquidated down. But yeah, I don't know. I'm growing an account with First Trade. If I ever want my money, I'll get my money. I've been through the rotation many times about switching brokerage accounts, and I have no hesitation of doing such a thing. No hesitation. If I'm not happy with a broker, I'll jump ship tomorrow. I have no problem doing that. You guys need to have the same attitude. Make sure that you're happy with your broker. If you're not, switch. You don't need to be married to your broker. That's just the way I feel. But yeah, I've never really, I'm not going to comment on whether or not First Trade, a reputable broker that is, being audited, that's been around for 30 years, is making it hard for people to take their money out. I'm not sure if I buy into that. I will buy into the mobile app not being good. I will buy that. I use their mobile app to monitor the account, but I will say that their actually web-based application is quite good. So, and remember, you're getting free access to the market. So don't expect everything that a full-service broker will have, because they're not providing you free access to the market, even in a self-directed account. All right? All right. Let me take a breath. I've been talking for an hour and 17 straight. All right, go to the FINRA org site and do a brokerage check for disclosures, ownership information. That's awesome. Great information flowing through the group. I wasn't comfortable with the Chinese ownership interest in some of the SEC FINRA disclosures. Would be better option than First Trade. And one is really good. They're both good. That's how Webull is. Chinese-based company, really pushing 2 free stocks for signing up. I started it, made a video, etc. Awesome. Thanks. It depends on your investing style. M1 is good for dollar cost averaging. I do agree with that. I value average my portions, so I prefer brokerages with different order types. Hopefully positive news with trade war next 2 weeks. That will give a jolt to the market. I don't think the stock market needs any more of a jolt. Stop Andrew Chapman fueling this fire. I don't know. We'll see what happens. But anyway, I kind of made my way through the community. I've got a little bit more questions here. I'm going to save it. But I'm going to get over to column 2 in the planning stage, where we start to identify some of the nuts and bolts of investing. Very important. And we start off with risk tolerance. I've said this many times. Determining your risk tolerance for somebody who doesn't have 1 red cent in the market is an easy exercise to do, to just say, if I was an investor, what type of investor would I be? A lot of people know more about themselves than they think they do. Do I think I could have an inclination to be more of a stock investor or a passive investor? So are you more active or are you more passive? Do you want to monitor your accounts more frequently or less frequently? Those are some of the questions that'll help you rhetorically answer what your risk tolerance is. And if you don't know, start as a moderate or a moderately conservative investor. Start on kind of the low end and maybe hope to evolve and adjust it from there. Maybe you adjust down to a 1, maybe you adjust down to a completely conservative investor, and you thought you were a conservative moderate investor, and you learn something about yourself to where you invest your first $1,000, the market goes down 30%, and you don't like to see that negative 30% in your account. Nobody likes it, but it's your tolerance to weather the storm, okay? That's what we're talking about when we're talking about risk tolerance. Now, we just had an exercise in the community about the account. The bucket that you choose is very, very important. And I want to stress for all you Robinhood investors out there, look at the order of the investment account that you choose. You really should be looking at the prospects of the Roth IRA first, of a self-directed nature, all right? So look at the max funding, the Roth IRA first. Until you get to the max funding on the Roth, you really don't need to be looking a whole lot further than that into taxable accounts or opening multiple Roths. I never recommend that. Just open one, you've got it, it's fine. And then once you max fund that, you can look to branch off, maybe increase your contributions to the 401k schedule. If you have one with your employee, you could do that. And then look to add those additional taxable brokerage account layers on top of it. Goal setting takes place in the planning stage. The products that you choose, we talk about that, the ETFs, the index funds, the single stock of a growth nature, some of the spider sector ETF products that you could purchase. So we try to whittle it down to where you're not looking at the entire investing landscape in one holistic picture. You're looking more individually and saying, I'm more of a passive investor. What's available to me? Well, we jump on Vanguard and we look. Multiple entities out there, sponsors of different ETFs. I typically try to gravitate toward the Vanguard product because they are some of the least expensive. I know there's a lot of good products out there that are very, very low cost options. Vanguard is just one of the competitive ones, all right? Determining your risk profile, that has to do with your passive or active profile, what type of investor you want to be, all right? That kind of comes out in the planning. The savings. Now, keep in mind, when you're progressing from the prep to the planning, you haven't spent any money. This is all free of charge that you can do. Now, if you want to buy into a stock market radar course, you can do that. That's freaking awesome. If that's the way you want to spend your money. You notice on the Independent Investor channel, I don't have any of that, nor do I have any plans to do that. Maybe someday down the road, I will do my own course. I do like that idea. I really do. I think that would really, really resonate with a lot of people, both visual learners and auditory learners. We can build a course to get through. Maybe some people prefer to learn that way as opposed to watching YouTube videos. They can just purchase a course and go through it at their own speed. However, I contend that the money that you would save by just listening and deploying some of the very simple techniques, you're going to end up with some success in the stock market eventually if you end up staying the course. All right, so very, very important. Savings. The supplement here. The supplement is really, really important in that what existing buckets do you have? Are you working? Do you have a savings? Do you have a checking? Do you have a budget in place? Do you have an employee sponsored? Do you have the ability to start to layer up? And that's a lot of people just contribute to a 401k, and that's good for them. They don't want any more layers. But you have to look at this opportunity here to supplement your existing holistic picture, okay? So where you have the opportunity to do that in the planning stage, you may have some existing investments through your employee, through 401k, 403b, whatever you might have, and you might be missing out on the opportunity to layer up with an additional self-directed Roth IRA account. So look into the prospects of that. How much does that cost you? Nothing. Zero. It's all about the education. Okay. The strategy is cool. Again, cost you nothing, but it kind of comes back to the profile piece a little bit. But the strategy is cool where you link together your inflows from your income and you say, where are my soft spots? Where can I pull $50 from my budget every 2 weeks? And the strategy is such to rechannel those dollars. And instead of losing those dollars to outflows, okay, I explain it to be the inflow of dollars and the outflow of dollars. In other words, it's paycheck to paycheck. But the strategy is to take that money and keep it. Pay yourself. Okay, so you intercept that money as it comes in. Normally it would be gone here to In-N-Out Burger, all right? Instead, we take that and we strategize that money and we put it into a retirement account. And a lot of people have that money. They just don't know that they do, okay? This piece here is kind of where the rubber meets the road. This is really where you stop talking about it. You stop the pre-planning. You stop the discussion with your spouse and you implement, okay? You take the action. You take the action step, and this can be very, very scary. It can be scary enough to actually keep people from investing. This right here, the action step. Because I know eventually we get to this point where talk is cheap. And eventually you got to kind of maybe pull the trigger a little bit on this thing. I think I was 15 years old when I first pulled the trigger on my first mutual fund, honestly. So it's been such a long time ago for me. Investing has just always been a part of my life. So it's very, very difficult for me to relate with some of you folks in the audience if you're in your 20s, you know, and 30s, 40s, 50s, and especially I had one of my members reach out and say, Ryan, I'm 65 years old, you know, I'm just starting to invest. I don't know if you have existing investment or if it is, in fact, your first. I can't relate to that. Do I think it's too late? No, I don't buy into that cliche stuff. I don't. If you want to invest, I'm not going to tell you that you can't. It's just you and I both know you're not going to benefit from the compounding effect. We can agree on that, okay? But the action piece, and then the trust is what you're going to have to deploy. You're going to have to trust the validation that you've got up to this point and trust the program before you go ahead and implement it, all right? So really important there. Once we get over to the action piece and you put this trust in motion, and I'm not saying trust me, make no mistake, you know the person that you're trusting is you, all right? You are going to make mistakes and you are going to have some success. Those two things I can guarantee you. In the stock market world, you're going to invest in some stock or ETF, and one of two things is going to happen, that of which I can guarantee you. Either it's going to go up or it's going to go down, all right? Sorry, can't be any more truthful than that. Can't be any more helpful than that either. But don't be surprised when either one of those two things happen. But when we come up here to the action piece, this sometimes gets a little bit cloudy for new investors, and understanding that if you put all of your ducks in a row and you start to take advantage and understand why the self-directed piece is so important, why reducing fees, why just the simple strategy of dollar cost averaging. And you guys know I strategic buy my accounts, a little bit different. I'm the only one who I've talked to. Some people do it. Some people call it channeling stock. That's kind of what I do, but not really. Dollar cost averaging is just a lazy man's way of entering the stock market. Don't mean to offend my ladies in the audience, but it's the lazy person's way of doing it. Okay, if you pick the 15th of the month to fund the account with $25, it's going in there whether or not the market is down or up. Okay. Now, I would rather strategically buy the market either on the 14th or the 18th if I get a nice heavy red day. Like today, if I could strategically buy the market, it would not be on a day like today. It would be on a day like yesterday. See the difference? I'm using my power of observation to monitor the stock market and buy consistently over the course of my life on a red letter day. The only thing that I wish I had for you guys is to quantify how freaking huge of a difference that's made for me over the course of my investing life. It is huge. And I don't have that data. I don't. I apologize for that. It would be so interesting. I could probably write a book on strategic buying because it makes a huge, huge difference. If you put a best fit line for me, it's on the low end of the best fit because I'm always following and strategically buying the stock market. When it goes down 100 points, okay, you buy, whatever. But when it goes down 2, 3, 4, maybe you get your 500, 600 down days, I'm more apt to buy on those days than I ever am on an up 200 day, right? Strategic buying, okay? Dividends, using the power of dividends to add and introduce to your portfolio as slow or as fast as you want, all right? Over time, you're going to see the effect of that compounding. Cold. I don't know what I meant by that. Good grief. I knew what I meant by it when I wrote it on there. I'll think about it here. But the ability to layer up in the account, think defensive. Okay. We give you that wide range of error over the course of your life. If we could just realize some of that money that we would surrender to fees if we went with a financial planner, okay, if we could just capture half of that back, then we're going to end up so farther along than we ever would having our money represented, all right? The opportunistic buying, that's another thing that I wanted to talk about. It's not the strategic buying that I talk about, but be a little bit opportunistic, okay? The Intel trade that I had this week, that's opportunistic. Don't be afraid to make a mistake to where you never do anything, okay? Dividend investing is very, very simple in that you just fund it, set it up for dividend reinvestment, or fund back the portfolio, whatever you want to do. Very, very simple. But opportunistic buying is where maybe you look at a Google here, down, off, as much as it is. I bought Google this week, and I made good money. Opportunistic buying, okay? Broker, that's where you actually choose your broker. So we put those options out there. You guys know the major brokerage houses and some of the cutting edge brokerage tools that you can go with. And out of this, you're going to get this empowerment piece. This is where you start to really come to terms with your own ability or own deficiencies as an investor, okay? So this is kind of where the magic starts to happen and you start to feel empowered. Over here, when this is all done, congratulations, you're an investor. We move over here to the monitor piece. You're an investor, all right? You want to determine whether or not you're a passive investor. You want to stick. You want to stick and stay. Don't tinker so much with your portfolio. Remember, some of the tinkering that I offer to you guys that I do, you have to understand that there's a large portion of my portfolio that just sits there and works for me, okay? So I just declare some of the tinkering moves. Why? Because it's entertaining, okay? But I make money, okay? That's the idea. Always look to improve, always look to involve, anticipate. That's an interesting one, anticipate. So what is it that I'm always saying about, look at the market, it's at an all-time high, what that's going to mean? Or can we anticipate that the market could go higher? What could I do in my portfolio to anticipate that move? What if the market goes down? What is it that I can do to anticipate that move down? Okay. Prepare, that goes with the anticipate. Learn that discipline. Be deliberate with your moves. Don't be wishy-washy. Okay. Don't make a move and then sell a stock and then beat yourself up over it. Be robotic in the stock market. It's business. It's not personal. If you make a good trade, pat yourself on the back for a couple seconds and then move on. It's done. It's over. All right. And then also identify the quality of your program. That's also super important. Okay. Now, the last thing I've got over here is the validate piece. Why it is that we put all this stuff in motion, why we sit on a 2-hour live stream on a Friday evening with Ryan. And I'm so glad that you guys do. You're so devoted. But I will tell you, as a community, There's so much good flow of information back and forth, and I'm losing my voice, but I'm still going to keep going because this is episode 50, and I'm so passionate about this that if you can transition over here, you can start to understand why it is what we do. Compounding interest is really why we invest, to get those investments put in place and to start that compounding effect. So your money's going to make you money. All right. It's going to liberate your dollars. That's going to be huge. As we get older, you're going to learn about how you can take some of those compounded dollars and then put them into preservation mode, because you don't want to continue to subject that money to over exposure to the market. That's why I always say, what's your exposure to the market? Are you comfortable with your exposure limit? I told you what mine was tonight, 46%. I know what it is. That's where I'm comfortable at right now with the current state of the market. What's yours? Okay, so where are you at? Are you comfortable with that level? Be proud of being abnormal. What does that mean to be abnormal? It means that if you want results that are superhuman, that are results that are not in the norm, results that you shouldn't be able to achieve, but you achieved them anyway, you got to think outside the box. You have to. You have to do things that may feel abnormal or unnatural to you, but you know them to be right. All right? You're going to have to do that. Just being conveniently naive about the stock market, and because your financial planner dresses really nice and maybe takes you out to a golf trip once a year, that's not good enough validation for me. All right. And you really need to make ask those hard questions of yourself. And if you've got the courage enough, ask those hard questions of your financial planner. Remember, it's business. Okay. It's not personal. It's your money. Financial security, you guys know that's one of my financial goals for the future. I'd like to get older and not have to worry about money. It's kind of pathetic, to be honest with you. However, money does allow you the security and the freedom to do kind of what you want. Maybe some freedom to do some other things, start some business, dabble in some real estate, maybe do some traveling, whatever it is that you want to do. Financial security is a big one. The reason why we go through all this is to be prepared in the future, to be prepared for unexpected expenditures. Expect the unexpected down the line. Okay, so super important here. It may not make so much sense back here, but it's gonna make sense when that unexpected medical emergency comes up. It's gonna make sense when that unexpected travel expenditure comes up. Okay, that's the prepare piece. These are some of those intangible things that are really hard to quantify at the beginning of your investment career, all right? This is where you realize your potential. This is where the plan that you put in motion back here, that you started on hope, really kind of shows you the potential of the compounding effect, all right? Perhaps maybe some generational wealth. Now think about that for a second, guys. If you're looking to build generational wealth for you and your family, and you're giving a large portion of that generational wealth away to the financial institutions, especially if it passes in an inherited Roth IRA to your heirs, think about how sad that is, okay? Wouldn't you rather take back that potential for your money to be given away that way? If for nothing else, this right here can be a very sound justification for self-directed investing. It can be just that validation, because this generational wealth is going to continue to compound over time. And if you're giving that wealth away, why do you think Edward Jones has $1 trillion of assets under management? Why? It's because those assets pass from generation to generation. They make so much money off of that money, and they don't even have to work for it. They don't have to do anything. 3% off $1 trillion, $30 billion. Not too bad for a year's worth of work. That's your money. All right, think about it. All right. And finally, the opportunity that you had here to invest. Not everybody has that. I know I talked to some of my community around the world, and they would kill to have some of the opportunity that that at least we have in the U.S. and especially some of the other European countries, Canada as well, and just the opportunity to get down here and seek out enrichment. A lot of people will not have that opportunity. They will not, and they know that. As much as they want to, they are not going to be able to get over. They may be over their mental barrier, but they just may not have the physical opportunity to seek out these and enrich their own lives. And every single one of you guys do. If you have that opportunity, man, do not pass up on this opportunity to take advantage and leverage it for your own financial future. All right. I just started my M1 account in March, and next payday it will be over $1,000. See, those type of success stories are why I do what I do. Very, very cool. I appreciate you leaving that in here. Congratulations, Mike, on 10,000 goal surpassed. That is really cool. Yep, that's very cool. I've got Rebecca, great friend of the channel here. I'm considering selling off my individual stocks and using that money to buy a variety of index funds. My stocks are solid dividend payers, but I don't have a huge time horizon to let dividends grow. I would say one thing, and this is just my perspective on that plan. If you're going to sell some good quality stock right now, I would assume that they are. Maybe consider not selling all of them. Okay, take it down to a position that you're happy with, even if it's just a couple shares. That way, your exposure level is limited. Okay. And then if you're looking to reintroduce that money in the form of an index fund, I love index funds. I think they're great. But make sure that you introduce it not all at once, okay? If you want to start an index fund, you can do that, but just introduce it slowly into those index funds so you're not taking a large chunk of money. I don't know how much you're working with, so I'm trying to answer the question as if you're, dealing with 10,000 or you're dealing with 100,000 or you're dealing with 500,000 or $1 million. I'm trying to answer the question in the same manner because I think my philosophy works no matter what. And also, the alibi in this conversation is don't forget the importance of fixed equity as well. Fixed equity is going to pay you no matter what. So some options to consider there for you, Rebecca, certainly. But again, just some ideas. You don't always have to just completely liquidate a position. You can keep some in there so it does work for you. But just make sure that if you're going to buy the market, remember you're indexing the market at a very high limit right now. So if it does go down, I want to make sure that you're not introducing it all at the same time. Okay. All right. Good progression. Just keep chugging along. I lost 25,000 last year, making all the newbie mistakes. I'm up 14% year to date. My monthly expenses are low. You are my mentor and gave me great advice, but you're so humble when I thank you. Yeah, I am humble. And that's, that's the whole point of this whole thing is for you to kind of realize how it is you can self-assess, that's really the key in this whole evolution. Guys, I've been going about an hour and 43 minutes here, getting toward the end of the stream. I'm going to cruise down here and see if I can't cherry pick some of these. I've got Officer Towers in the group, Mr. Al Towers. Dang, Ryan, I've never seen the board look like that. Hope all's good. Getting that market upside with limited risk. I've already limited my risk. I take the risk off the table. It's not exposed. Remember, deliberate. Deliberate. That's in my monitoring, okay? I exercise many attributes from both the monitor and the validate category. And I just hope you guys kind of understand how I use this. This is what it means for me, and hopefully it can mean something for you guys. I wanted to do something special on the 50 live stream. God, to say it like that. Most of them have been about 2 hours. It's been pretty crazy. But I am getting close to kicking off here. Give you guys the opportunity to hit the thumbs up button if you haven't done so. I thank you guys for coming in and spending some time with me on a Friday evening. I know you guys may have better things to do, but I cannot question the devotion of the group We will not be doing the live stream next Friday. I can't. I have a dinner engagement Friday evening, that of which will be the culmination of my work obligation. And then we should be able to increase the frequency of the uploads to YouTube. That's what I'm hoping for, if I feel like it. Remember, I retain creative control on the Independent Investor channel. I give what I can, and I don't overdo it. I don't. I do this on the side. You guys know that, and I give what I can, but I'm not going to overdo it. I'm not. This project is a long project for me, and I just don't see the point in rushing daily uploads just to flood YouTube with content and blah, blah, blah. Okay? I'm not going to do that. Hey, Ryan, what do you think of Occidental? Just sold all 45 shares of MPC and bought 50 shares of Oxy. I think they're both great companies. I really do. If you had a 45 share, that's a pretty big position. I would have said that you potentially could have liquidated half and just kept both. Marathon Petroleum is going to run. I've kept my shares ever since I've recommended it. I'm down 13%. I'm totally fine with it. I'm not worried one bit. It's a great, great company. Great. I was compared to a human. Yeah, okay. He's paying attention. I didn't compare you to a human. I was saying that you are a human. Good stuff, guys. Thank you so much. Appreciate it, Ryan. You make us laugh because you always have the BS right around you. That's true, man. It's because it has to do with money. And it's really unfortunate that there's a lot of sharks. You know, it's the ultimate pursuit of money. And I tend to look at money just a little bit different. People look at me awkwardly when I say that it's not necessarily about the money. I pay very little attention to the money aspect. I pay so much more attention anymore, the older I get, to the plan that I have. I spend the majority of my time looking at my plan, areas for improvement. I typically don't. The more money I get, the less I focus on it, and that's the God's honest truth. It really is. But I think you have an error of truth about that comment, that there is a lot of BS. What amazes me is how many people fall for that. They really do. I feel bad for them. I really do, because a lot of people, they get acted upon, because I think a lot of people want to achieve financial security or strive toward a financial plan and be better stewards of their money. And a lot of people will, in good faith, seek out that information only to be misguided. And there's not a whole lot I can do about that other than just advocate for what it is that you guys know I've been advocating for the last 2.5 years of the channel, and we'll continue to do that. That's all we can do. And if I'm over-delivering on the value and under-delivering on the charge that it costs a subscriber to come on and listen to some content on YouTube, then I think we're winning the battle. I really do. So let me cruise down here, make sure. I'm a silly family says, love this channel. I love you too. It's awesome. Thank you for coming in. Understand if you can and will make money, don't listen to your friends. Listen to them. But just be proud of your program. That's why I say defend it sometimes, you know. I throw it out there. I think it's funny. You know, when I started the Independent Investor channel, it was one of those things to where it was like, I have a YouTube channel. And now it's like, I have a YouTube channel. If you want to watch it, you can. If not, I don't care. How many followers do you have? 14,000. It's 14,000. I don't care about that. I care about the devoted people who come in and consume the message and are going from 0 to 10,000 in a year by maybe deploying some strategies that we push through. That's what I'm all about. I'm not all about getting a number that is an inflated number. I'm interested in the degree of impact we're having on the devoted few thousand. That's what I'm interested in. That's where the impact is. So I don't care about an inflated number on a subscriber base. I don't care. All right. I try to talk to my coworkers about investing. I think I had a pretty good comment there, and it just jumped on me. God darn it. Had quite a few people jump in here. I've got InfoVest in here for the first time. So basically only want to put REITs into an IRA. No. Nope. I have my exposure in REITs through VNQ, which is the Vanguard's real estate investment trust ETF. But I have owned multiple REITs in my history. I've made really good money with real estate investing. But if you want to pull my investments after some time and buy real estate, then divs are nah. I agree. Don't mix your investing buckets. If you want to buy real estate, go ahead and do it. I'm sure you could probably watch Grant Stephan, and he could probably teach you how to be a millionaire overnight investing in real estate. So good luck. All right. Yeah, I think I missed that comment, god darn it. That was a good one. I do apologize for that. I was going to address a good comment there. My rule is only to buy on the red. That's right. My wife's Roth is filled with REITs. Qualified. Yep, good. For me right now, traditional IRA works because I'm single, so I get more money back when I file my taxes. That's correct. Yep, a traditional can be really good. You can also designate a traditional, a self-directed traditional account. So just keep that in mind. Guys, I am going to wrap it up right there. I've lost my voice. So that's the level of commitment. We lose it every Friday. We're good to go. Minute and 51. Really good. I'd like to again thank the channel creators for coming out. I hope they enjoyed their barbecue. Hopefully they listened to most of the live stream. I didn't see a whole lot toward the end here from Joe, but I do enjoy him popping on. Really one of the best up and coming channels in my opinion. And my opinion carries weight, no doubt about it. I think it'd be kind of cool to get him hooked up with Scribner, see if we can't accelerate the growth. He deserves it. So if you have not subscribed to any one of these guys' channels, the Financial Investor channel, holding on to the end here, the live stream, Dave popped in as well from the Average Joe Investing, as well as Joe Carlson, a couple other channels, Investing Wisely, long-standing supporter of the channel. So we want to try to empower those channels as well, be a supportive community on those folks, trying to stoke up awareness on investing, guys. Thank you so much for tuning in to the live stream this Friday. Remember, next Friday will not be happening. It will not be going on, but we will reconvene the following week. So you guys have a great, great weekend. Good luck in your investing future. And we will reconvene again on the live stream Independent Investor channel in 2 weeks. Guys, thank you so much. Have a great weekend. Terry, I just saw you pop in there. Have a great weekend. Thanks, guys. Appreciate you all.